Here is something most investors do not know. The investments you are losing money on can save you money on taxes. It sounds counterintuitive, but tax loss harvesting is one of the most powerful tax management tools available to any investor, and it is completely legal, well established, and underused by most people who would benefit from it. Today I am going to show you exactly how it works. Tax loss harvesting is the practice of selling an investment that has declined in value, realizing that loss on paper, and using it to offset capital gains elsewhere in your portfolio, reducing the amount of tax you owe. Here is the basic process. Step 1. You hold an investment that is down from what you paid for it. You have an unrealized loss. Step 2. You sell it. The loss is now realized. It is a tax event on your return. Step 3. You use that loss to offset a gain you made elsewhere. The two cancel out, reducing your taxable gain. Step 4. You reinvest the proceeds into a similar fund immediately, maintaining your market exposure. The key insight: you have not changed your investment position in any meaningful way. You have simply converted a paper loss into a real tax deduction. Let me put real numbers on this. You sell stock A at a gain of $20,000. Normally, you would owe capital gains tax on that $20,000. But you also hold stock B, which is down $8,000 from what you paid. You sell stock B realizing the $8,000 loss. Now you only owe capital gains tax on $12,000, not $20,000. At a 20% long-term capital gains rate, that is $2,400 in tax on the smaller amount versus $4,000 without the harvest, you have saved $1,600 by doing nothing except selling at the right time. Now for the critical caveat: the IRS is not naive. The wash sale rule states that if you sell a security at a loss and repurchase the same or substantially identical security within 30 days, either before or after the sale, the loss is disallowed. This closes the obvious loophole of simply selling a stock, claiming the loss, and immediately buying it back. The 30-day window applies on both sides. If you bought more of a stock in the 30 days before you sold it at a loss, that can also trigger the rule. Substantially identical is where it gets tricky. Selling one S&P 500 fund and buying a different S&P 500 fund from another provider may or may not trigger the rule. The IRS has not provided clear guidance. When in doubt, consult a tax advisor. The practical workaround: sell the loser and immediately buy a similar but clearly distinct fund, a different index, a different sector fund, to maintain your exposure while keeping the loss valid. Not all gains are taxed equally, and this matters for how you prioritize your harvesting. Short-term capital gains, investments held under 1 year, are taxed as ordinary income. Depending on your bracket, that can be 22, 24, 32, or 35%. Long-term capital gains, investments held over 1 year, receive preferential rates, 0, 15, or 20%, depending on your income. Tax loss harvesting is most powerful when you are offsetting short-term gains, because the tax rate you are avoiding is much higher. If you can choose which gains to offset, start with short-term. Then apply any remaining losses to long-term gains. And if losses still exceed your gains, we move to the third piece of the strategy. What happens if your harvested losses exceed your capital gains? The IRS allows you to deduct up to $3,000 of net capital losses against your ordinary income each year. If you have $18,000 in losses and only $10,000 in gains, you offset the $10,000 completely, then deduct $3,000 from your ordinary income and carry forward the remaining $5,000 to future years. That carry forward has no expiration. It rolls over indefinitely, protecting future profitable years with your current losses. This is particularly powerful in volatile years. A big market drawdown can create a large loss bank that reduces your tax bill for years to come. Tax loss harvesting is not equally valuable for everyone. It benefits most high earners in the 22% or higher bracket, investors with significant capital gains to offset, those holding large taxable brokerage accounts, and people who regularly rebalance their portfolios. It is less useful for investors in the 0% long-term capital gains bracket, those whose investments are entirely inside tax-advantaged accounts like IRAs and 401ks, where gains are not taxable to begin with, and those in low-income years where the tax savings would be minimal. One important note: tax loss harvesting is a legitimate tax strategy, not tax evasion. You are not hiding income. You are using the tax code as it was designed to be used. But always consult a qualified tax advisor to ensure it applies correctly to your situation. 4 things to remember. 1. Losses have real value. A realized investment loss offsets taxable gains dollar for dollar, reducing your tax bill in a very concrete way. 2. The wash sale rule is non-negotiable. You must wait 30 days or buy a genuinely different fund. The IRS closes this loophole firmly. 3. Short-term losses are the most valuable. Offsetting a 35% ordinary income tax rate saves far more than offsetting a 15% long-term rate. 4. Excess losses carry forward indefinitely. Up to $3,000 of net losses deduct from your income each year. The rest rolls over until you can use it. Every loss in your portfolio is a potential tax win. You just have to know how to use it. If this video helped you, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Friday, we are completing the Week 7 series with bonds, what they actually are, why the price and yield move in opposite directions, and why every serious portfolio should include them. See you Friday.